Our next speaker is Andrew Palmer. Andrew Palmer is the Business Affairs Editor, overseeing the coverage of business, finance, and science at The Economist. He was formerly Finance Editor and Banking Correspondent, having joined The Economist as Management Correspondent in February 2007. Prior to this, from 2006, he was at The Economist Intelligence Unit, a sister company where, among other roles, he led the editorial team, conducting bespoke research programs, surveys, and reports. And he's going to speak in defense of financial innovation. Over to you, Andrew.
Thank you. Thank you, Grant. Thank you, everyone, for being here. I know the post-lunch session can always be a little low on energy, so I appreciate you being here so diligently and promptly. I am going to try and defend bankers, and that is a difficult thing to do, but that's my task. In 2005, some researchers at Yale University decided that they tried to train monkeys in the idea of money. And what they did was basically train them to realize that they could use tokens in exchange for food. And the experiments went very, very well, and the monkeys began soon to respond to price signals. And so, when the price of a food went down, that's where they chose to deploy their tokens. But some other types of behavior emerged as well. Lots of monkeys strayed into a life of crime, running off with trays of tokens. Monkeys were seen paying other monkeys for sex. So money has a way of corrupting behavior in monkeys and in humans. And we know this very well after the financial crisis. When you think about bankers, certain words come to mind: bastards, greedy bastards. And I had a position during the financial crisis of seeing this industry sort of fail to work, actually. I was going to say work, fail to work on an epic scale. So from 2007 through to 2013, I had this very privileged perch watching massive incompetence, outright criminality, bad judgments. You know the story. But there is another side to the industry. It is not told. Torrents of books and articles are written about how terrible finance is. But it, of course, has an incredibly constructive and useful side too. And that narrative needs to get told if we're to have sensible public policy debates. So I want to argue that, yes, finance can be destructive, but it can also do great good. That when you worry about finance, it's less the areas where ingenuity is at play, more the stable parts of finance that have a tendency to go wrong, and that finance itself can solve some of the issues that have dogged the industry and that tripped it up. So I want to talk first about some of the good things that finance can do. And in some ways, this ought to be a very unsurprising proposition. If you think about the way that our modern economies have developed, finance has been there right from the beginning, holding our hand. So when we needed to invest, we invented debt. When we needed to mitigate risk, we invented insurance, and so on and so forth. Now, lots of people would say, okay, that was great as far as it goes, but finance doesn't need to keep innovating. We've reached a sort of a plateau. But that's transparently untrue. There are huge questions and issues that we need to resolve, from climate change to water scarcity to incredible wave of aging populations. And I just wanted to pick out a couple of examples for you of things that are going on right now that are examples of finance being socially useful in the phrase. And the first is helping poor people to save more. Now, in the past, pre-crisis years, what we did as a way of solving the problem of poorer people in society with not much cash was let the banks rip by giving them mortgages. So you'd bet on the collateral rather than the creditworthiness. That route is obviously being cut off after the crisis. Banks themselves are disincentivized to lend to poorer people now because the capital rules have gone up, and basically, if you're going to make lots of money, you don't choose the less creditworthy parts of the population. You can go to a payday lender if you're short of cash, and 40% of Americans, as the slide shows, couldn't come up with $2,000 if they needed to in an emergency. Payday lenders are everywhere. There are more payday lenders in America than there are branches of Starbucks and McDonald's combined. But we know that they can also behave in ways which are suboptimal and predatory. The most common sense solution is to try and get people to save more. And the way to get them to do that is to harness an impulse that we all have, which is to play lotteries. Lotteries are, it turns out, something that all countries like to indulge in. The Australians are the unluckiest country. They lose most, but the Americans spend most on lotteries. American households spend more on lotteries than they do on dairy products and alcohol each year. How do you use this lottery impulse for good? Well, an NGO in Boston called Doorways to Dreams thought, we know that people like to play this. We know that people who are poorer, the less wealthy members of society, spend more than they should on this. That's an opportunity to acquire them as customers very cheaply. So they set up something called a prize-linked savings account. And the idea is that for every $25 that a poor person puts in, they get a raffle ticket. And the raffle ticket ends up being part of a draw at the end of each month, and there's a cash prize. And the cash prize is not big, but it's the fact that you can win something that's attractive. And what has happened is that there has been 4 of these things set up in the States since 2010, and there has been $100 million worth of incremental savings from this plan since then. Good example, very low-tech example of finance being harnessed for good. Next example is also in the sort of socially utilitarian area, and the social impact bond is an instrument that has been innovated and invented here in the UK. How many people here have heard of it? Okay, just one. So there are 2 big problems with public spending, crudely put. One is that we're running out of money, and you need, therefore, to make hard decisions about where to spend, given the sort of secular growth of entitlements over time. The second is that a lot of public spending is inefficient. So of 10 federal programs in the states that were evaluated using randomized control trials for their effectiveness in the past 20 years, 9 either did no good or were actively harmful. And my favorite example is Scared Straight, which was a program that took juvenile offenders and put them into the company of hardcore prisoners in the hope of scaring them straight. And you can imagine how that worked out, not very well. So we have 2 problems, lack of cash and cash being deployed inefficiently. The social impact bond tries to answer that problem, and the way it does it is to bring in private capital to fund social spending in areas from homelessness to preventing asthma amongst children to prisoner rehabilitation. That money from private capital funds social organizations who run more ambitious projects than they otherwise would. Those projects are monitored, there's a lot of data flying around, and if the projects work and the outcomes are better than a control group, then that represents a notional saving to the public purse. And that notional saving then pays back investors. So the primary example, the pilot example, is in Peterborough, in the east of England. And in 2010, the then Labour government set up a pilot program where private investors funded a prisoner rehabilitation scheme for people coming out of that prison. They were short sentence offenders. The parole system didn't treat them well. People would often reoffend that first day in order to get back into prison and have shelter. High rates of recidivism. This private money funded a very ambitious 5-year scheme, which is designed to meet people at the gates, to get them trained in things like construction, to do things on a scale which they hadn't been able to do before. And the outcomes in terms of recidivism are then measured against the control group. We will see the final results of this in 2016, but the interim results show a big improvement relative to the national group. That represents a saving to the public purse, and that will go back to investors. It's a really simple idea, but it aligns everyone's incentives really well. It was invented here, but is now spreading around the world. There are 100 of these things either up and running or being planned at the moment. And there's also now, and that's the reason for this slide, there is now a development impact bond. So an iteration of this that works in the world of development. And you can see in the field of prisoner rehabilitation that whatever problems we have here, they are much worse in other parts of the world. So the way that these work, DIBs as they're called, development impact bonds, and I expect we'll hear more about them, is that, again, money from private investors. If the programs work, then the money comes back to those investors from multilateral organizations, from DFID, from the World Bank, etc. So these are 2 examples, and I'm very happy, I think we've got some Q&A later to talk about others if you wish, of finance doing good. And I think it's a pretty simple proposition that finance can do good. Now, of course, you will be thinking to yourself, well, we may know that, but it does an incredible amount of bad too. And the crisis is exhibit A in that. But when you think about the crisis and what caused it, property was the asset that caused the crisis. Now, there are all sorts of ways that you can apply blame for the crisis. Lots and lots of people and institutions and markets failed. So this is not to say that only one thing was responsible, but one asset class was at the heart of it. It is there every time there is a banking crisis, every time there is a systemic financial crisis, almost without exception, property is there. It's big, so it has the ability to bring down the system. It has tons and tons of unspecialized investors, i.e. people like you and me, working away, making bad decisions about what to buy and not thinking properly about it. And it has the illusion of safety, and this is always problematic. When people think that things are safe and they turn out not to be, there's panic, and finance can't cope with panic. So property is secured against collateral. As individual borrowers, we think, well, at least I've got a house. I'm not frittering away my money. The bankers are incentivized to think of this as safe because if we stop paying on our mortgage, they have this piece of collateral that they can realize some value from. Now, obviously, there was lots of bad innovation going on around property during the crisis. So we had these crazy negative amortization mortgages. We had pick-a-pay. We had ways to get people who shouldn't have owned homes into homes. And that continues to be a big problem. The policy setting in this country, in the States, and elsewhere is to encourage people into homes no matter what, and it's nuts. And really what we need is a new type of innovation, an innovation that in finance doesn't privilege debt, doesn't encourage people to lever up as much as they possibly can, but tries to diffuse property's most dangerous characteristics. And there are a couple of examples of this too. So again, in the States, securitization is a sort of a word that is now sort of commonly taken to mean blowing up the financial system. It's a way of structuring cash flows that, in the case of mortgage-backed securities, are the payments that we as homeowners make to the banks, and they go to investors. In the States, they now have rental bonds, so you can rent your property, and those payments also go to investors. And it's a way of encouraging capital at scale into the rental market. That's a good thing in countries like ours, where there is too much in the way of home ownership. And there are also examples, and they are nascent, around shared equity. So the idea that lenders take some of the risk, they will share in the upside if prices go up, they will share in the downside if they go down. There's a small but very interesting lender called Castle Trust here in the UK, which has that model, but also ties its borrowings, its liabilities, to house prices. So basically, if there's a house price crash, what will happen on the asset side of the balance sheet is that the value of their assets will go down, but they will also have to pay less out to their creditors. That's a really nice example of a matched balance sheet that is happening here, hasn't been tried anywhere else in the world, and hopefully works. Now, the other thing that finance can do is solve the problems of finance itself. So property is an asset that often goes wrong. Finance, and banks in particular, are also wired to fail. Very highly indebted. They've got this massive mismatch in maturities between the money that they take in, i.e. our deposits, and the money that they lend out, i.e. Mortgages. And financial technology, or Fintech, provides some very hopeful answers to those problems. So Fintech, I'm sure, is a phrase that you hear a lot about. It's very buzzy. There's tons and tons of new startups being formed, both in London, but also in the States, Berlin, and elsewhere. Goldman Sachs reckons that about $5 trillion worth of financial services revenue is at risk from Fintech, from startups who do things differently in this world. And it's been very interesting to see the banks themselves change their attitudes very, very fast. So about 18 months ago, they didn't know what fintech was. About 12 to 6 months ago, they said it's just irrelevant to us. It's a sort of interesting experiment. And now, publicly, they'll say the same, no need for us to worry. But they're frantically setting up incubators in Silicon Valley. They're working with the Level 37 crew in Canary Wharf. And they're trying to work out how on earth they stop this train which is coming at them. And the reason that they're worried is that fintech platforms, and I'm going to talk specifically here about peer-to-peer platforms like Lending Club, Funding Circle, RateSetter, and others, is perfectly designed to address their vulnerabilities. So these platforms, as I'm sure you all know, are where we as individuals can put our money onto the platform and fund people who want to borrow. There is no bank sitting in the middle of that transaction. These platforms are great for a number of reasons. Structurally, they don't have the problem of leverage that the banks do. They're not actually going into debt. It's we as end lenders who are taking the risk. And they don't have this liquidity problem of short-term borrowing and long-term lending. Basically, if you put your money onto that platform, you fund a borrower, then you do so for as long as that loan lasts. So both of those structural things are handled. But at the same time, they also have better customer service. They don't have any of the regulatory costs that you can see the mainstream lenders have. They don't have a branch network to cope with. They are able to undercut the banks massively, both providing credit to borrowers at cheaper rates, but also having a very nice margin and spread on the activity that they fund. There are lots of these things happening. So there's payments, there's robo-advice in wealth management, there's crowdfunding, and the first crowdfunding exit for equity happened last week. And there's peer-to-peer. So all of this stuff is happening, and it is a way for finance's very, very obvious and glaring, but sort of intrinsic flaws to get handled. I don't want to suggest that banks are going to disappear. There will always be banks, but if you actually look at what they do, the stuff that really distinguishes them is the current account. That's the thing that it's very hard for fintech companies to go after, and in part that's because our current accounts and our deposits are guaranteed by government. So it's a rather narrow sort of field in which banks can feel comfortable, and you will see these other institutions, these new startups, nibbling away at the rest of their activities. I'm going to stop there. This is a very, very quick and simple run-through of some propositions. Finance can do good. The places to worry are when you're looking at assets which are stable and big and seem safe, not the ones which are sort of full of wizardry and investment bankers. Property, in particular, is the place to get worried. And thirdly, that financial innovation itself can help to address some of the flaws of finance. And with that, I'm going to throw it open to questions. So anyone who wants to ask me anything about this or Greece or anything else, raise your hands.